Welcome to your channel, Dr. Gazavi. Economics and financial issues are very important. Let's go.
Global weather-based trading strategies. Since the seminal work of Saunders, 1993, financial economists have shown considerable interest in the role of weather in financial markets. Most of the existing research focuses on the effects of sunshine on investor mood and behavior. It documents a positive effect of sunshine on stock returns and on investor propensity to buy stocks. However, a branch of the literature casts doubts on the robustness of the sunshine effect on stock returns. For example, either find an insignificant sunshine effect on returns or argue that such a relationship is sample-specific and spurious. Research on the effects of other weather variables such as temperature and rain is more limited and subject to debate. While most studies treat the weather effects as static and uniform across countries and seasons, Dong and Tremblay, 2021, find that weather effects on global stock returns generally vary across temperature regions and seasons. They test the relation between weather variables, sunshine, wind, rain, snow, and temperature, and country index returns, and find that except for sunshine, which has a universal positive impact on returns, the weather effects are highly dependent on temperature region and season. Documenting the weather-stock return relationship has a unique implication on market efficiency because if weather, a clearly exogenous factor to the economic system, is statistically related to future returns, this is strong evidence against market efficiency. However, prior literature falls short of demonstrating the economic significance of weather on asset pricing, which leaves prior results subject to the data mining critique. For example, no weather variables are included in the anomalies examined in the comprehensive studies on return predictability at the index level, despite the fact that these papers survey over 20 index-level return predictors. In this paper, we investigate the economic importance of the weather effects on equity pricing. Specifically, we ask two related questions. First, how economically important are the weather effects on stock returns? Are the impacts of the weather variables on stock returns comparable to those of economic fundamentals? Second, given that the weather conditions are correlated, do strategies formed on multiple weather conditions lead to substantially different trading profits from strategies based on a single variable, such as sunshine? We address these questions by testing the profitability of global index-level trading strategies based purely on daily weather. Our main research question is to assess the profitability of weather-based strategies. We argue that this is important for two reasons. First, the gross returns of weather-based strategies directly reflect the economic impact of the weather on financial markets. We construct a variety of weather-based trading strategies, described below, and compare the magnitude of the strategy returns to the buy and hold global index return during 1993 to 2012. The premise of using the World Index return as the benchmark for comparison is that the World Index return reflects the economic value investors realize from a passive buy-and-hold strategy over a relatively long period. If weather's effects on returns are negligible, we should expect gross returns from any of the weather-based strategies to be indistinguishable from zero. Therefore, finding that weather-based trading strategies generate mean returns comparable to those of global index returns would indicate that weather exerts economically significant impacts on asset prices. Furthermore, we assess whether the returns of the weather-based trading strategies are driven by fundamental factors by regressing these returns on the World Equity Index returns. Finding significant alphas indicates that weather effects are not driven by standard risk factors. Second, the weather-based trading strategies we propose fill a void in the prior literature. Regarding weather-based trading profits, the most relevant study to our paper is Hirschleifer and Shumway, 2003, who use a mean variance efficiency framework to show that sunshine can be used to enhance the Sharpe ratio of a trading strategy. Relative to Hirschleifer and Shumway, 2003, our weather-based trading methodology improves on several fronts. Firstly, we construct trading strategies based on multiple weather conditions simultaneously instead of single conditions, e.g. sunshine, only. In addition, we conduct tests of trading profits out of sample instead of using the full sample period. Lastly, we relax the mean variance efficiency assumption. Test the profitability of out-of-sample weather-based trading strategies. We construct portfolios of country stock indices using ex-ante information. Specifically, we assume that weather can predict daily index returns, and we use the weather-predicted returns to form portfolios. To predict daily index returns for our sample countries, we first estimate the weather return relation by running OLS regressions of daily index returns on the weather variables for each of the temperature regions, cold, mild, and hot, and each month, following Dong and Tremblay, 2021. To avoid the look-ahead bias, we estimate OLS coefficients over an estimation window that precedes each trading day. We then use the pre-market weather conditions and the OLS coefficients to predict returns on each day of the trading period. We construct two types of strategies. In a long-short hedge strategy, we form a hedge portfolio by taking a long position in the index of the country that has the highest predicted return and a short position in the country that has the lowest predicted return, and we rebalance the portfolio daily. In the long-only strategy, we simply take the long side of the trade and rebalance the position daily. Clearly, the profitability of our weather trading strategies depends on the quality of the daily return prediction using the weather variables. Our return predictive method differs from the prior literature in two ways. First, we group equity indices by temperature region and month, and make separate return predictions for the 36, 3 regions times 12 months, region month groups, which improves the precision of the estimated weather return relationship. Second, we use all 5 weather variables in the predictive regressions, because as documented by Dong and Tremblay, 2021, including multiple weather conditions is crucial for the performance of the strategies. For both the hedge strategy and the long-only strategy, we consider a global strategy in which all countries are tradable, and 2 additional types of trading regions. The temperature region strategy constructs trading portfolios for each of the 3 temperature regions, cold, mild, and hot, whereas the time zone strategy constructs portfolios for each of 3 time zones, the Americas, Asia-Pacific, and Europe-Africa. We find that weather-based trading strategies generate large gross profits. During 1993 to 2012, the global hedge strategy generated a mean annual return of 15.2%, T equals 2.30, which confirms that the weather effects on returns are systematic rather than spurious. To put this in perspective, DataStream's World Equity Index earned a mean annual return of 6.2%, T equals 1.50, during the same period. The risk-reward ratio also strongly favors the hedge strategy. The hedge strategy has a Sharpe ratio of 0.462 compared to 0.243 for the World Index. The comparison of the magnitude of the weather hedge profits with that of the Equity Global Index confirms that weather exerts an economically significant impact on the stock markets. We find similar results when applying the hedge strategy to the temperature regions or time zones. The hedge strategy produces an average gross annual return up to 13.3%, T equals 2.19, for the cold temperature region and 17.7%, T equals 2.66, for the Europe-Africa time zone. 0.3. Furthermore, using the long-only strategy, trading profits are also substantial. It generates a mean global annual return of 13.4%, T equals 1.86, with a Sharpe ratio of 0.361. A key reason for such high magnitude of weather-based trading profits is that we use all 5 observable weather variables to predict daily returns. If we use one weather condition at a time, such as sunshine, to construct portfolios, trading profits are mostly insignificant in the global hedge or long-only strategy. For example, during 1993 to 2012, the global sunshine-only hedge strategy generated an insignificant mean annual return of 1.74%. These findings suggest that it is important to consider a comprehensive set of weather variables rather than a single condition in generating profitable strategies. Conceptually, since multiple weather conditions exert an influence on individuals' emotional state, as shown in psychology research such as Sangill, Gonzalez de Rivera, and Gonzalez, 1991, only allowing one weather condition to affect mood suffers a major omitted variable problem. Most prior studies fail to document comprehensive effects of multiple weather variables on stock returns because they do not condition weather effects on temperature region and season. However, Dong and Tremblay, 2021, show that because the effects of most weather variables, all but sunshine, are specific to the temperature region and season, conditioning the weather return relations on region and season is necessary for detecting such relations for most weather variables. In this paper, we provide empirical support for this insight from the perspective of weather-based trading profits. Since the conclusion that substantial weather effects exist depends only on gross profitability, and data on transaction costs around the world are not readily available, net of transaction costs profitability is not the focus of this paper. However, with reasonable estimates of the costs of index trading, our calculation suggests that the weather-based trading strategies can be profitable even after factoring in transaction costs. See Section 3 for details. This paper makes several contributions to the behavioral finance literature. First, our finding that a global weather-based hedge strategy generates an annual mean, gross, return 2.4 times that of the world index during our sample period indicates that weather exerts economically important impacts on stock returns, which reinforces the previous literature's findings that weather effects are real rather than spurious. Second, we document that it is crucial to simultaneously consider all 5 weather variables to construct profitable trading strategies. While Dong and Tremblay, 2021, provide plausible interpretations of weather effects for different temperature regions and seasons, many of the effects cannot be predicted ex ante, making the interpretation of weather return relationships subject to ex post hypothesizing. By contrast, in this study we shift our attention from the psychological causes to the economic impact of the weather effects, and remain agnostic regarding the exact channels through which weather impacts stock returns. Our focus on the profitability of weather-based trading strategies makes inferences immune from ex post hypothesizing. Therefore, our approach provides easy-to-interpret and unambiguous evidence in support of the claim that the weather has economically important effects on global stock markets. Finally, our evidence indicates that weather effects are related predominantly to investor emotion rather than economic fundamentals. The notion that weather influences stock returns via a psychological or emotional channel is not new. Example, Hirschleifer and Shumway, 2003, and Bassi, Colacido, and Fulgieri, 2013. However, we are the first to make this inference using an out-of-sample weather-based trading strategy. We do not rule out the possibility that weather affects stock returns in part via an economic channel. Example, adverse winter conditions reduce labor productivity. However, it is difficult to imagine that weather influences economic fundamentals more than do business decisions, example, corporate investment, financing decisions, and macroeconomic conditions. Furthermore, when we control for overall economic shocks proxied by world index returns, we continue to observe significant abnormal returns in the global hedge strategy. Therefore, the finding that a global weather hedge strategy generated a mean gross return greater than that of the world index during our sample period indicates that it is improbable that weather affects stock returns mainly through economic fundamentals. We examine the economic significance of the weather effects on index returns by designing trading strategies that exploit the return predictability of weather. Specifically, to predict returns, we use pre-market local daily weather and the OLS coefficients from the regressions of daily index returns on weather variables. We consider two types of trading strategies: a hedge strategy that takes a long position in the country with the highest predicted returns, and a short position in the country with the lowest predicted returns, with daily rebalancing, and a long-only strategy that simply takes the long side of the trade. Our out-of-sample strategy yields large trading profits for both types of strategies. The mean annual hedge strategy returns range up to 16% for the cold temperature region, when trading is restricted to Northern Hemisphere countries, and 17.7% for the Europe-Africa time zone. Furthermore, the long-only strategy generates more stable profits than the hedge strategy when applied to temperature regions or time zones. The mean annual returns are up to 16.3% for the Europe-Africa time zone and 17.3% for the mild region, in the latter case, with trading restricted to Northern Hemisphere countries. Such weather-based trading profits are striking given the world index return during the same period was 3.1%. Much of the high profitability of our trading strategy is attributable to the fact that we consider all 5 weather variables simultaneously, and we estimate the weather-return relation more precisely for each temperature region and for each month. In fact, a weather-based strategy is no longer significantly profitable if we rely on one single weather variable, or if we estimate the OLS coefficients unconditionally for the full sample. Our results therefore support the view that weather effects on returns are of first-order importance. Under the null hypothesis of market efficiency, there should be no relation between weather and returns, let alone profitable, weather-based trading strategies. Consequently, we do not require net of transaction costs profitability to show that weather effects are real. The large magnitude of the weather-based strategy returns supports the interpretation that weather influences global stock returns via investor psychology. Future research combining weather with other economic variables may reveal interesting new patterns in stock return predictability. Abstract. We estimate the profitability of global index-level trading strategies formed on daily weather conditions across 49 countries. We use pre-market weather conditions, sunshine, wind, rain, snow, and temperature, and the statistical relationship between weather and returns to predict index returns each day. In the out-of-sample test for our 1993 to 2012 sample, a global weather-based hedge strategy produces a mean annual return of 15.2% compared to a mean world index return of 6.2%, corresponding to a Sharpe ratio of 0.462 relative to 0.243 for the world index. Our findings confirm that multiple weather conditions exert economically important impacts on stock returns around the globe. Thank you for watching, and please subscribe to our channel. Economic and financial issues are very important. See you in the next video.